Good afternoon. This is Tom Alexander. It is Sunday, February 6th. It's about 2:45 p.m. Eastern Time in beautiful Charleston, South Carolina. This is the video addendum to the report that you all have been sent. A couple of things. If you would please subscribe to the channel. If you will hit the notification bell, you'll get notified as soon as these things hit. And if you like the material, please like it. Okay, let's talk about the market. It's at a really, really interesting juncture. Let me show my screen here. Of course, I say the market is at an interesting juncture almost every week, and I realize that because it's interesting. That's one of the reasons we do this, right? Okay, so we had the big bungee jump out of this very compressed level. And the 4,300 level is important. I'll show that again separately in a minute. We'll talk about it. But what happened out of this, because of both the fact that it was a balance area, so you're looking for an initiative move, just forget the internals. But then you add on the internals, there were some internal readings that were more extreme than we saw in March of 2020, frankly, some. And so I was sort of expecting a break to the upside. That began Friday week ago. Continued last week, and then Thursday and Friday we had sort of a surprise downdraft, at least in my mind. It was certainly different than what we've seen, but I've been talking about this market being different for some time. If you look at all the green arrows that began back in November, these are days on which we had NYSE closing breadth of negative 2,000 or lower. And typically you don't get, I don't know, 3, 4, 5 a year maybe. And when you get them clustered like this, it's one of two things. You've changed now, we've transitioned and we're in a bear market, or we're in the most protracted correction that we've had since that March 2020 low, which quite frankly, that would be overdue. I don't know if we're in a bull market or bear market, and quite frankly, it from a trader's perspective, it really doesn't matter. If you honor the levels that are created through the auction market and you honor these structures, you'll stay out of trouble. And you'll also have the opportunity to profit wildly. Let me look over here at the report and just see if I'm missing anything that I want to show you. I'm not going to show this for the sake of time. I'm not going to go through and show you the profile view. I put the profile view of the of each index that we trade, the cash index, in the report with a path. There are numerous paths the market can take from here. From a trading perspective, the levels you see on my screen right now are important. Ideally, we'll hold Friday's lows. You certainly want to hold this balance area structure. Now, let me go back over here a little bit again, and let's go to this chart. This is going to be a little bit shorter this week, but it's pretty. As far as, okay, here we go. Okay, so this is the, again, the SPX, the green arrows are times where we have had negative 2,000 breadth. 4,300, this is a really, really, really important level. Levels matter. I put that in the report. And we'll go back in just a second. We'll take a look at some other levels and spend a little bit of time doing that. But, you know, you can have all these techniques to analyze the market. You can be a market profile trader, an Elliott wave trader, Fibonacci trader, all this other stuff. But if you go back and you look at, and this is an auction market concept, these levels are determined as important by the market itself. Now, you can't know that this level is important at this point in time, but after you come over here and you test this 4,300 again, you tested it here, and then a few weeks later, you tested it again, bell should be ringing, say, okay, this is an important level. We spiked below it here. And in doing so, we created this balance area. And this spike was created by, again, one of the most compressed conditions we've seen. Well, the most compressed condition we've seen since the March 2020 low. And as I alluded to earlier, by some measures, more compressed than during that March 2020 decline. So this is an incredibly important level. If this level breaks, you want to be paying attention to what's going on at that point in time. And I wouldn't be fading that break. You want to see what happens. Okay, let's look at some other levels. We'll go through here. Actually, I'm going to do this. I'm going to reduce this because it's not the point of what I want to make, and I want to be able to expand the chart a little bit. And we'll just go back. We'll just sort of scroll back, and I'll show you now. One of the remarkable things about this rally over the past 2 years is how well it has held levels. And up until November, those levels were defined by pivots. This was a test of this level. But again, the pivot lows that were defined by negative 2000 breadth readings, none of those had been taken out prior to over here in late November and into December, and it's still going on. So that was a remarkable pattern that has now been broken itself. Here you see the series of negative breadth readings in this sort of mini crash decline that occurred in about 6 weeks back in February, March of 2020. Here you have 3 consecutive breadth readings, negative breadth readings, as this market is forming an important low. And you can also see this created a level. Now, I don't know exactly what the number was here, but somewhere in here around this 2860 level, the market could not generate any downside momentum. It kept testing that level and testing that level. It tested it again here, and then it took off. This could happen again. We could have a situation where we come down next week or in a few weeks and test this 4,300 level. But I can assure you at that level, you're going to get, it's an inflection point. You want to talk about, I don't like to use the term support and resistance. I like inflection points. In an inflection point, it opens your mind to the idea, yeah, we're going to have a sharp move here. Now, maybe it's in the direction that we're reaching this inflection point, or maybe it's the opposite direction. So this is an example of that. And then you go over here. This was an important level as it broke. This was a sustained uptrend, and it was marked similarly to the previous 2 years by an incredible pattern of higher pivot lows all the way up until it broke here. You can see this was a very important level, and it ended up holding until it broke over here. You can see how it was tested here, that bounced here. You guys can do this for yourselves, and you can see, but I have learned through the years to honor levels. These levels are created through market activity. And when they break, it means something. And you can go down in time frame. You can do this on, I don't care how granular you go. Of course, the more granular you go, the more noise you have, the more false signals. But it's an auction concept. It's pretty simple, but it works. And it works because we're using trade activity from the actual buyers and sellers in the market. It's very popular right now to use these option gamma levels. Well, I think you'll find, those of you that are using those levels, is that those option gamma levels line up uncannily with auction market levels. And the auction market levels have been prevalent in the market since way before we traded options, and they're still prevalent. So guys, that's pretty much it for this week. I'm sort of leaning that this thing is going to show some strength next week, but if it doesn't, this 4,300 level, the importance of this level cannot be overstated. You guys have a wonderful week, and we'll speak soon.